Nothing we say is investment advice. Please pause on all 3 pages of this disclaimer and read it.
Nick Petrozello, May 20th, 6 p.m. EST. And we're doing the BAM, Brotherhood of Ancestral Masculinity, Wednesday afternoon, trading markets and crypto Zoom chat. And we got Larry here. And we were just talking a little bit about some market stuff. Larry, you're over there with me at Algo Factory. And for those of you who may not know, I have a company called Algo Factory, and I run that with a business partner. And we teach people how to build their own trading plan, their own trading engine, their own trading algo, whatever you want to call it. And the latest thing is this agentic AI trading. It's kind of the thing now. And if you want to do that, that's awesome. You want to have a computer trade for you, then you're going to have to build an algorithm. That's what they run on, right? So we teach people how to build that engine. Okay. So interestingly enough, though, we had a quite the morning in trading. I had a great trade on, and I like to trade Forex more than anything. I would like to trade NASDAQ. I'm not set up for it right now. But I had a trade that basically looked like what I'm about to put on the screen. Something like, let's say this. Okay. And I think I had a stop loss like up here. I was right about there. I think I'm just recreating it, just, to keep it simple. And of course, Larry, you saw the whole thing. You were there. And it looked great. It was going into profit. It was a trade that I put on last night. And if I were to do the replay function, I can walk you through what happened as if you were there. So let me zoom in, put this to the center of the screen. And this is the EUR-USD. This is the euro versus the dollar. And one of the things we're going to talk about is a question that you had, Larry, about the pairs being connected, right? All the different Forex pairs kind of running in the same direction and sort of thing, right? And there's a few reasons for that, but there's one in particular. So I get in this trade, and it had all, my algo is met. The rules for my algorithm were met, and it had all the earmarks of, a trade I would take. And it looks like, fudge. Let's see here. We go to a different chart just to map this out, because that's not going to do. This one will not do. Standby. Nope. What is this? Trend volatility. Yeah, that's something I'm working on. Yeah, this will be the one. All right. So let me rebuild this. So the trade pretty much looked like this. Might even had a deeper entry. I think it wasn't that great of an entry, but it was good as a breakout entry, can't complain. And everything was going, according to plan. And as it is with the market, things don't always go to plan, right? You get things that happen, you get market events. And so look, here's the thing for new people. If the price goes into the green area, that's for profit. That means I'm winning the trade. If the price goes up into the red area and breaks through the top of that, that means I've lost the trade. And this is a good trade. So as I go to sleep overnight, it's going just fine, in and out of profit. Zoom in a little bit so you can see it, in and out of profit, right? And then all of a sudden I'm in the middle of trading, and that right there happens. Bam. I get knocked right out of this trade. Okay. In fact, I think the stop was up here now that I'm looking at it close. So this big, just crazy move up takes me out of the trade. And, that can be a little upsetting, right? It's like, man, this is good. And this was clearly a news event because price wanted to go down. The news came out. It was something to do with Hormuz Strait. And it's just nowadays, that's what the trade is, right? And it took me a minute to figure out what was going on because, the news takes a minute to hit the news sites. Like, people got to write articles, right? The news doesn't just appear. And then I took a look at oil, and I noticed that there was a massive dump in oil right at that time. Like, okay, it's probably Hormuz related. And then the news came out less than 10 minutes later, about 10 minutes later, because it was 7:14 a.m. when I got murked. And so I got stabbed right through, lost the trade. It's fine. A few steak dinners down the drain, it happens. And what are you going to do, right? So I went ahead and I'll tell you what I did. As soon as my algos allowed me to do so, I got back in this trade and I made half the money back immediately, right? So if I put a line here right where I got stabbed out, I dropped to a lower time frame. Oops, there we go. And I jumped down to, like, say, the 5-minute time frame. I saw it spike up and I was like, okay, it's still looking strong, right? After I stopped out, trade still looked good for a long. I'm like, okay, it's going the opposite direction, but is this just like where they're messing with me? Or is it gonna stab up and then head back down and just screw me? But I waited very patiently until the conditions for my algo met. And I entered right about here and I had a stop loss pretty tight. It wasn't a huge risk, but it was a notable risk. It was a good solid risk. And I saw the pop and I was like, okay, as soon as it popped up harder, I had my finger on the trigger to get out. And there's ways to automate that. If you want to automate that, you can automate. In fact, most of my trades have an automation for certain certain amount of risk to reward, right? So if I make enough money on a trade, I have a way to automate getting out of that. I was manually trading, which I prefer to do anyway, because I can. And I got out right about here. I didn't get the top of this. I was kind of like, okay, let me see if it continues up, because the news that came out was pretty bullish. And then I noticed that, I started to see resistance, and I saw some things happen in the algo. I said, okay, that's enough. If I want to get back in, I can. Yeah, I had a nice, 3-1. So that's it. Game over, right? Took the money out, and I got back half of what I lost, So that's just the kind of thing that happens. Like, these news events come and they screw up your trade. If you know what you're doing, you have a good algorithm, you have some patience is actually the key, then yeah, you'll be fine. You can make your money back, but it has to be based on rules, right? This is what I told the group at Algo Factory. I said, look, don't try to make it back. Just look to see if the algorithm provides you a new entry. Look to see if what just happened in the market with all that volatility gives you an opportunity to take another trade, and then you take that trade. If you have the mentality of I've got to make it back, then you're going to run the risk of revenge trading, and you'll lose money, because you're taking a trade not with the purpose of taking a trade based on your rules, but you're taking a trade with the purpose of I've got to make it back, right? And that's a problem. So a lot of people would just enter like, oh, maybe it'll go up, and they enter and you don't know anything. I waited until my algo told me that I could take a trade, and I was able to recuperate 50% of the loss that I experienced this morning. I went full body on that short, I went full trade size. So, hey man, you lose some trades. That's just how it happens. I lost it publicly. Everybody saw me lose that trade. I think it was even I think people even on YouTube saw that trade before it was lost. And that's the difference between, losing credibility because all you post are your wins, right? If you see somebody post like more wins than losses, then they still post their losses, and they're probably realistic. So, Larry, do you want me to go ahead and talk about why the pairs are moving in unison to some degree? No, Larry.
Yeah, if you could.
So I'm a Forex trader. I actually I cut my teeth in silver margin trading 15 years ago, but it was more of a speculation based on fundamentals, right? I wasn't doing any technical algorithmic type trading. And then I got into cryptocurrency, and I picked it up pretty quick. The opportunities were so strong that I really dug deep into crypto trading. And sure, there was a whole lot of luck involved getting in at the right time and all those things. But I maximized it. I really learned how to use the charts, use the tools on the charts, such as all that gobbledygook you see at the bottom there. So that's technical trading. And when the first crypto bear market happened, not a lot was understood about crypto. So what I did was I went ahead and taught myself. Actually, I hired a coach, paid him thousands of dollars to teach me how to trade Forex and how to trade technically, how to build a trading plan, how to actually treat my trading like a business, and what trading psychology is, and all the kind of stuff that I teach over at Algo Factory. Okay. So one of the things that we do over there, we're Forex traders in that group. And I wanted to be a Forex trader, and that's why I went ahead and did that. So Forex is currency pairs. You have the euro versus the dollar, like you see on the right here. You've got USD C80, that's the dollar versus Canadian dollar. You've got the Australian dollar versus the dollar. You've got, that's what that is right there. Silver and gold are not Forex, but a lot of people will trade those. You have all the Japanese yen pairs, although I'm not trading those right now because there's a lot of manipulation in that market. They're protecting their currency right now. So it's really easy to just get knocked right out of a trade simply because they're protecting their currency, and you can't predict when that's going to happen. There's the dollar versus the Swiss, which is just pretty much like the euro in reverse. There's the British pound and the dollar. I don't trade that. It's kind of a messy pair, but at this point, they're all messy pairs just with the kind of stuff that went on today. So there's a million pairs out there. The euro versus the Aussie. You could go down the list. There's the New Zealand, the euro Canadian, the Aussie New Zealand, any pair you can imagine. But I stick with the majors, which are the first ones I mentioned. And right now, Larry was talking about how they're all moving in unison. Well, there's two reasons for that. For one reason, you have the euro versus the dollar, and then you have like the British pound versus the dollar. Well, the euro and the British pound are related because they're basically European economy, and they're both traded against the dollar, which is like the same thing. So the euro versus the pound are always going to be very slow moving pairs. If I brought up the euro versus the pound, you'll notice that not much happens, and that means they're literally moving in unison. The euro versus the pound is just a messy, boring ass pair. It's just a boring ass pair. Nothing ever happens with it. You get these moves here that are very hard to predict. These are momentum ignition algorithms, which is a whole different conversation. Very difficult to predict, very difficult to trade. I wouldn't touch these for any reason, right? But they move in unison because they're economically linked. Okay. Now the dollar and the euro they're not so economically linked. They're very different economic engines. They're different geographically. The companies that belong to the economies are obviously very different. European versus American, not as interlinked. You have the Australian dollar versus the AUD versus the USD. And if you compare that to the British pound, that's going to be boring as well, because the British pound and the Aussie dollar are both British, right? If you know what I'm saying. Like Australia is part of the Commonwealth and it's subject to the crown. So a lot of their economies are going to be financially linked. Although there is some autonomy there, of course, you have Australian companies, British companies. So if I were to put up AUD GBP, I think it's actually GBP AUD. You'll notice it looks a little bit like that EUR GBP. It's just it's a bit messy, and then you have these weird moves that happen, and then they catch up to each other. So it's not a real party to trade. Okay, it's a great way to lose money. It's just like trading the euro versus the pound. Okay. So those pairs are going to move in unison because of their economic interlink, or they're economically interlinked. Now, the other reason that you might see pairs that are moving together when they otherwise shouldn't be, like for example, USD JPY, AUD JPY, GBP JPY. Well, the Australian versus Japan and the GBP versus Japan are extremely similar for the same reason that the Aussie dollar and the British pound dollar are very similar, right? It's just comparing the Aussie to the British pound, and you're switching out the Japanese yen. So it's the same exact reason why those two pairs move together, because they're both part of the British Empire. You have the dollar versus the yen. What you find interesting there, the Japanese yen has its own unique place in the whole structure of the economy, right? Of the world economy, of the world equities market and debt market. And what we found, and this is going to really answer your question, Larry, because what I've just said are all reasons that we all know about. And as Forex traders, as FX traders, we know that these countries are either, part of each other, or if you put these pairs together, they act like that. That's something that's kind of common knowledge in Forex. But what you might not know is the role of the Japanese yen and the fact that there's a knock-on effect. And what I mean by a knock-on effect is, look, the Japanese yen, there's a carry trade issue. The world equities markets rely on cheap debt that comes from Japan. And this has devalued their currency to the point where they're actually having a hard time economically. So Japan is going to defend their currency. Typically, this is done by raising interest rates. But Japan can't raise interest rates because that actually would run the risk of cratering the US stock market. And if you've noticed, if you just look at the NASDAQ, all it does is go up. And the minute it wants to go down, you get all these weird and wacky news events that force it back up, right? So, keep doing something different here. Let me rotate back to this chart. Okay, get out of replay mode. Exit replay. There we go. Okay, let's see here. NASDAQ. So the NASDAQ wanted to go down. And all of a sudden on Monday, really Tuesday morning, you get this news. And it even happened on Monday morning as well, before early in the day, you get this news. There's some progress being made in Iran, right? Now, over the weekend, you got bad news saying, Iran and US talks stalled. And then you have the Sunday open when basically all the market kind of freaked out and started heading down, right? So then all of a sudden, immediately you get, good news from Iran, there's progress. And then the market actually still continued down. There's more good news. They keep pushing it up with good news. And once it gets to a certain point where it dangerously wants to fall, then you get both really good news and liquidity injections to keep the market going up. Okay, so the market must go up. And if I zoomed out right here, this pattern that I drew right there, that pattern has like a 78% chance of heading down. It really wanted to break it down. And if I just delete all this gobbledygook, you'll notice it did not head down. It headed up. It really wanted to head down, and it did not. And if you look back through the NASDAQ's history, you'll notice that every time price moves down, it gets caught and forced up. And if it goes down for a few weeks, it gets caught and forced up. Now, there's always money going into the NASDAQ, 401ks and stuff like that, and retail buys dips. And there's a whole very complex story to this, right? But in the end, what actually matters is that the stock market continues to go up, because we're in a very inflationary cycle. Money continues to be devalued, and that causes assets to go up in dollar terms. They're printing money. When you print money, but that money is just being printed, nothing actually is making money, you're not making any wealth, then you just have more dollars chasing around all the same goods and services, and therefore you have the inflation problem. right? Well, inflation is being hidden in the stock market. And as long as you're a boomer with a 401k and you see your retirement continuing to go up or not head down, then you're going to be happy in the midterms when you got to vote for all of Trump's buddies. So the market must go up. And then they'll probably let it deflate and come back to some, period. They'll pull a certain money out of the market. They'll get their shorts ready to go. They'll buy their puts and let the market probably fall starting in like November or October. And then I'm guessing we might see a nice solid retracement going into the following year. And it'll probably go down and sideways for like a year. I'm guessing. And I'm only guessing based on the election cycle. There's a lot of reasons why what I'm saying could be wrong. But the boomers must be satisfied. And satisfying boomers involves stock market and retirements staying up high. Now, the reason this relates to Forex pairs all moving in unison, the reason that the stock market continues to go up is because we print money out of thin air to pay for everything. And when money goes into the market, that money itself is debt. All dollars are debt instruments. So what we're doing is we're borrowing at like whatever, 0.5% or whatever the number is to print the money, right? You have the commercial banks, they get it first, and then they loan it out at a higher percent. And then those banks loan it out at a higher percent. And they do it in the fractional reserve banking. So basically, $1 becomes $100. And that's just how money is made. And it's all done by printing debt. It's promising future income of Americans. It's using your grandchildren to pay for all the money of today. And when you borrow at even a small percentage and the money that you use to pay that back is also debt. So if you're borrowing it like whatever, let's just say 1%, and then you're borrowing at 1% to pay for that 1%, then you're continually taking chunks out of whatever money you use because all money is debt. So you're having a compounding debt situation even when you don't borrow money. Simply printing the money creates that. Now we also have huge amounts of credit creation, loans on this, loans on that, credit cards, car loans, student loans, home loans. Debt is used to pay for literally everything. And we're at a situation where we have $39 trillion in the debt right now, the national debt. And by the way, 80% of that is within our borders that we owe it to ourselves. And then on top of that, there are unfunded liabilities to the tune of 200 trillion. And that's an estimate. Could be higher. Who knows? Unfunded liabilities are like, we got to pay people Social Security in the future. I mean, these are big things that need to be paid for. They're not even counted in that. And that number continues to explode. But if you just look at the actual funded liabilities, we are adding $1 trillion in debt per quarter. That means that the debt is growing at 10% annum. And it's bigger than that because it compounds. It's more than 10%. I'm not going to try to do compound interest in my head, but I bet you it's closer to 12% per year. Is our economy growing at 12% per year? No, negative. I would venture to guess it's not growing by anything at all.
But who does that? Who is the debtor, the dettee on that?
We are. For 80% of it, 20% of it is owned by like other banks. So Japan owns about $1 trillion. China owns under $1 trillion now. They used to own $1 trillion. They've been selling it off. Japan's been selling it off too. And then about $4 trillion, I think, it's all wrapped up in Europe, and kind of like Brussels and like Luxembourg actually. So there's a lot of it that is out there in that regard, but most of it is owned right here in this country. We owe it to our pensioners. We owe it to we use it to fund the government just to pay for these useless jobs where 22-year-old gender studies majors get to work for 2 hours a day and pretend that they're valuable in some way. So basically that's where a lot of that goes.
But there's no threat if that debt if that debt goes unpaid.
Well, the threat is that the system will fall. So you have entire companies, businesses, all kinds of monetary flows that are created. Hold on a second. Good fellow allergies. So you have the economy is all based on that. Our local supply chains all based on that. Companies are based on that. Government programs are based on that. So what'll happen is a lot of people will simply lose their job. Well, entire jobs will go away. So ultimately,
you're talking about government sector jobs.
Well, not just government sector jobs though. All of the like prevailing wage jobs where federal money pays for building like schools, and I mean, there's a lot of like all the money that subsidizes the farms.
Yeah.
The amount of money that is taken from, I mean, a lot of it's our tax money, but our deficit every year is, I don't even know what the number is, but I think our tax receipts are not even half of all the money we spend every year, if memory serves. So, we are borrowing, I think, at least as much as we're taking in tax receipts. You have tariffs and you have other money that comes in, but none of it's scratching the surface on the amount of debt that we borrow, let alone what we owe. Like we're making interest only payments on a massive debt. We can't even afford to chip away at the interest at the principal. And as a matter of fact, we continue to add. So it isn't as simple as like, oh, we're going to just write it down. I mean, you can write it down, but guess what happens when you write it down? Nobody around the world wants to buy our debt. And in order for things to work, people need to buy our debt. It's not so much like what happens to the debt. Yeah, sure, we could write it down and make some deal within our borders, right? But what happens to all those countries that own trillions of dollars of our debt that are now worthless? Because that's a default. You've now defaulted. You have European banks and important people and private, people who own some $4 trillion, not to mention the countries that own it. You got China and Japan holding on to about $1 trillion each. We just forfeit $1 trillion. Like that's in order to if that debt goes away, we're done. Like our position in the world is done because our entire position in the world is predicated on our capability to make people money with our debt effectively through the stock market. The world invests in our stock market. That's another place. Why would just making the debt go away be a problem? Our stock market would disappear basically. The entire world is in our stock market. Our stock market is the biggest game out there, right? We have all the liquidity. Now the stock markets are starting to catch up, but by the same token, you're not going to see anything go up like Nvidia. You know what I mean? And sure, it's all fake money, but at the same time, you make money on fake money. So it's got to go until it can't. They got to ride it till the wheels fall off, right? And what they're probably going to do is make a deal, and then all the debt gets restructured, and there's a bankruptcy, and then the U.S. no longer has the position that it once did, and then all of a sudden you're going to see us probably in we'll just be like on UBI and socialism, and we'll try to rebuild our economy, and we'll try to we'll come up with some new things, but by then you'll have a lot of AI, and we'll just be whoever holds assets will have a chance of being okay if you can hold on to them. If you have a skill, then you'll have a job and continue to do okay. So it's really, just getting rid of the debt. I don't know. It's just you're essentially eliminating the entire reason for the United States to exist as a leading country in the world. Because our military, I mean, sure, it's a good military if you want to knock over mud huts, but Russia and China are technological peers. We couldn't go against them if we wanted to. Not in a full-on real deal.
No, I don't know. That's a macro conversation that we can have later.
But it's part of why all the pairs are moving in unison.
Yeah.
Okay. Because it's all debt based and it's all the same debt. It's Japanese and US debt. Hold on a second. I need to I got a couple things going on in the background. Give me one moment. Where the flip is my control station here?
Which pairs are like the most volatile typically?
Historically, the British pound, Japanese yen. Stand by just for a moment, folks.
You can get a lot of volatility in some of the exotics, but the spreads are crazy.
Gotcha. Okay.
Like I've played around with the South African currency, and I've noticed that if you're not trading, and I would be cautious even trading during market hours, I've gotten into a trade and say I'm going long. I get into a long trade, and it's when my execution goes through, it's like 2/3 of the way all the way to my stop loss because that's how big the spread was.
Yeah,
and then it'll bounce all over the place too, so you'll get wicked out. Like you'll have 100 pip wick just to stop people out.
I see.
There's people that live in that space, but man, you got to have nerves of steel.
Mm-hmm.
Okay, sorry about that. What space are you talking about?
He's talking about what has the most volatility, and it's JPY does, but you can see a lot of volatility in some of the exotics, but you have to be careful because the spreads are so crazy.
Yeah, you'll lose half your money just getting into the trade.
Yeah, exactly.
But as far as if you want to get a reasonable spread, the British pound Japanese yen is the most volatile. But actually, I'll show you guys something that I built. It's needs refinement, but if you look at the screen here, I actually coded this. So can you guys see the on the top right, this box?
Yeah.
So let me get the latest. It's a little buggy. I had it working, and then I tried to change a color on it, and the whole code got all jacked up. So I don't know, start over if I don't have to. But this this ranks all of the volatility. So this volatility percentage is usually, I don't know what this 0.1 is, but it's from 0 to 100 as far as like a level of volatility. So it's like, it's 6 out of 100, 9 out of 10, or 90 out of 100, right? And so it shows you what's the most volatile Forex pair per time frame. So right now this is on like the 1 minute time frame. So if I go to like I think I took it off this actual page here. See, I've got about 3 versions because, I'm trying to make them work. So let me see if I can apply the entire layout. Let me see if I can add it onto, let's go to the Euro first of all. Go to my scripts. I don't code, I just use AI. I just happen to be pretty good at using AI. If I was a coder, I'd be really good at using AI. But I know this, so I'm pretty good at using AI in that sense, right? I know like algorithms, so I know how to talk to the AI to get it to do what I want to do with coding algos. Okay, so it says it's on here, so it's not showing up on the screen. So I had to go through a couple iterations. So it made, it's just got a runtime error. Okay, I know what this is. Yeah, shit. I was going to show this off, but right now I need to fix the code. So long story short, it ranks the 8 major Forex pairs in what's the most volatile and in what direction, right? It's pretty cool. And what I did was I told the AI to like compare each, pair of the major pairs, matrix them, and then find a baseline of volatility based on those. So it's a floating baseline of volatility. There's kind of a floating average of volatility, and then measure the volatility of each pair compared to each, other pair, and then rank them, and then give it a value of 0 to 100, where 100 is the most volatile of the group, or whatever, right? I've even forgotten how I did it. I just freaking told it what to do, and I had it working, and it was pretty cool. So, but yeah, typically British pound Japanese yen is the most volatile. That is the case. So I may have to start over on that whole thing. And that's just how coding works, I guess. I'm new to the whole world of it, and I don't pretend to be a coder. So that's that. But volatility is good. You want volatility. There are things that you also want, though. Pairs that are clean. Like if I were to go if you look at the British pound US dollar, otherwise known as the cable, GBP USD, see all those crazy wicks where these wicks happen, like the candles wick out a lot. That's not very easy to trade. That's a lot of stop outs. So it's the way that it creates structure is a bit unpredictable. So you can run into problems trading pairs that behave like that. And the cable is like, it's kind of the original pair. It's actually called the cable because it was the first pair. And if memory serves, what they would do is they literally had a cable going overseas to have like on monitors, this pair's doing that pair's doing this. And the exchange rates were being recorded on a regular basis. And as a matter of fact, my family had a big hand in that. I had family in precious metals. And when they first got into that, they also wanted to speculate on currencies before there even was a Forex market. So they literally were like going to foreign exchange. Right. And they would have, and this is something, I don't want to get too into detail about it, but they had cameras, and those cameras were like in like London and, Hong Kong. And so when the exchange rates over there changed, they would write it up on a chalkboard, and then you would see it on your camera. You change it on your chalkboard over in your country. So they were linked like old school that way. Now the cable itself, I think that preceded when my family was doing that. That was kind of an original foreign exchange game, and it's called the cable. Cable connected overseas, right? Okay, so that's the story. Even though there's like some volatility, this sort of wickedness, all these wicks, it's very, very scammy. The euro has a fair amount of that too. The euro is known for liquidity grabs, but it's not as bad. It's not as bad as the pound. There's a bit more smoothness, and the euro was created, late 90s, or was it the early 2000s? So because of that was like, I don't know. I think that's why there was like a good foundation, because they linked the euro to the US markets in a way. So the way that they were linked, I think, made it just much more smooth, right? The British pound is an older currency, and they have a lot of influence around the world left over from the British Empire. And so, and a lot of prices get set over there. And I think a lot of the reason that it's scammy is because they're creating the scams. So, anyway, that's a little history. What do you guys want to see? Or what questions do you guys have?
I have a question, if I can put it in. If you'll help me to understand a DMI indicator a little bit better.
DMI?
Yeah.
Let's see. Let's take a look.
The directional moving indicator.
Okay, well, let's take a look at it. DMI, directional movement index.
Yeah.
Okay, so I'll create a new chart here. It looks like the DI, like when I do ADX plus DI. That's what it looks like.
Yeah, and then they have the third line on it is the negative, the D negative with the D positive with the opening high, opening low.
Let's see here. Let me create a new chart. Remove indicators, and let's go ahead and not letting me equalize these. Okay, well, that's fine. Let's add the DMI on, and let's go ahead and look at the settings. If I right click on the indicator itself, which is on the bottom here, I go to about this script. Collection of 3 separate indicators combined into one. Directional movement consists of the ADX plus DI. Okay, it's the same thing. It's literally the same thing as ADX plus DI.
Okay.
So I'm very familiar with this. So the ADX is going to be the red one. So yeah, this is ADX plus DI. Okay, so I'm going to erase everything and look at the ADX. I used to use this a lot. I don't like it because it lags. It's a very lagging indicator. Let me make this easier to see. So I'm not a big fan, but the way it works is that, I'll put a line at 20. Some people use 25. Okay, but once the ADX goes above 20, then you have more like tradable volatility, right? The problem is with the ADX that as it's going above 20, you get volatility initially, but as it starts to decrease, it's still above 20, but the volatility is actually decreasing. And then you bottom crawl. But once it breaks above 20, you have some volatility, right? But the problem with it is that basically by the time you get the volatility, it's already starting to slough off. For example, like right here, sure, it's above 20, but it's just kind of mucking about, right? So, but that's how it works. Above 20, you have volatility to trade. Below 20, you don't. Now, some people use 25, right? And that all depends on like what you're trading. You have to back test, determine what level you choose to determine where the volatility is tradable for you. Now,
is there a better volatility indicator to use?
I was just trying to develop one right now. But is there a better one? I mean, I don't know. I don't use it. Let me see. I use momentum rather than volatility, right? But let me go back to the settings.
So that's your stochastic RSI?
Momentum is a stochastic momentum index. So, the directional index is really simple, right? If you have a very broad separation between these two, then you have a bias. So let's just say your momentum jumps above 20, your red here, which should be the negative, the bearish, right? Then you're going to have directional bias downward. It's only really good, in my opinion, when it first kind of breaks out above the 20. You break out above the 20, your directional bias is bullish, to go up, right? And then if you see it kind of go back towards 20 and then kind of pull up a little bit again, then your bias is still good, but it can just pull right back down. So it's kind of like if you're sloping upward, it's going to work to a degree, and then you just have to use like structure to know when to stop watching it, right? So if structure is not in the way, you get a break above 20, and your bias, then you can kind of use it structure, right? So here it breaks above the structure, and then you can possibly trade above that. So did you have a question? Were you saying something?
No.
Okay, I think my own mic was coming through. So yeah, that's kind of how that works. Like I've tried to use it for years, and it's never worked out that great. Here's what I would do, since you're looking for a volatility index. Like really, the best way to play volatility is to just play market hours. I play the opens, and you're gonna know volatility because of the way the candles are moving, right? But if you want, like, if I were to go to Gemini and say, what is the best indicator on trading view to predict or indicate volatility, I let it tell me. That's going to list me however many I tell it to list me. In this case, it'll probably give me 3. Squeeze momentum. Yep, I used to use that one. ATR, exceedance probability. Oh, Lux Algo. I used to talk to Lux. Lux makes good stuff. Bollinger bandwidth. BBW, I used to use BBW, never used historical, never used the chop. That's Lux Algo as well. Let's see. So, but there's a couple here, like, let's look at one that I've not looked at. Unlike the entire struck with the age of percentage-based risk, how prices deviated from its average. Okay, so let's look at historical volatility just to see what it looks like. You could go back to that search and say, give me 10, and just test each one. So I go here to indicators, and I go to historical volatility. Now, how does one use it? I right click on it, right? I go to about this script. Okay. Statistical measure used to analyze the general dispersion of security or market index returns for a specified period of time. So this seems to be aimed at only like stocks or indexes. So I don't know that this is going to work on Forex. It may identify by the average deviation from a financial instrument's average price when in the set time period. Okay, this should work on anything. Options traders use this to calculate probabilities of trades. Volatility is often called the fear gauge. That is not the case at all and is a misrepresentation, blah, 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 blah. It's actually calculated more often than not by using standard deviation. There are other ways calculating it. Okay, I'm just kind of skipping a lot of this. The distance of a security's price moves in relation to its mean value. However, it can be used to measure other specifics, including loss probability. Our index prices move away from the image. All right, so I'll put it this way. The farther a price moves away from its average, the more volatile it is. Right. So if you have like an EMA, if price moves away from that EMA, then this is going to go up. So if I do a 5-minute, like, I don't know what EMA it's based on, inputs a length. So it's based on a 10 EMA. So if I was just to put an EMA on there, I guarantee you that the farther away this goes from the 10 EMA, the bigger this distance is, right? I can almost guarantee you that. So that's just all it really is. I can almost guarantee it. That's why I know to look at the length. It's a 10 candle length, which is going to be a 10 length EMA most likely. So if I were to go to here, or SMA. So if I just type in SMA, you can see price moves greatly away. Well, let's make these more visible for you guys. Let's go to style, expand that, and then we go to make this yellow. Now, the more price moves away from this, the greater this number gets. Do you see? So price is kind of tracking right here, and you see that it's low. So as price gets more volatile, this number goes up here as it moves away from its average, right? And then you see it kind of touch its average and then cross really hard highs. So you see it go down a little bit as it converges with the average, and then it just breaks right above there. And then it starts to track the average. Now, the candles are moving a lot right here, so you have a good high distance, but once the candles get really small and trace the average, then you get where this is pretty low. That's a good measure. I like this one. It's very simple. It's a very simple measure. So it's pretty good for volatility. Not bad. Now, I don't know how useful it is, but I guarantee you, if I were to use this, the way I would do it was I would track it on like maybe a higher time frame that I'm trading. So if I was in the daily, right, then I'd be like, okay, it's like super volatile right now, right? Oh man, this is going up. This is getting really volatile. And then you'll notice that it just kind of tracks. And again, that this adjusts as you go. So it's all relative, right? So right now, this looks like it's like really high at 36, but as you see the volatility really pick up, now 36 is like way down here. So you got to understand that it's about like, this adjusts. That's what I'm trying to say, right? Goes all the way to 250 as silver freaks out. Super high volatility right here. And now you're back down to like the 50, sort of 30 levels, and 50 and 30 are kind of what you saw back when, silver was sitting at like $30. So if I were to go to like, say, the euro, it's a little more stable in that sense because you didn't have this big, massive run. Let's delete all this drawings. So, but this is daily, right? So as you get this crawling up, then for that period of time, volatility is pretty good. But the question is when is it going to just turn back around on you? This is kind of how indicators work. They're not quite as predictive, but if you have a multi-time frame analysis, then you break it out into three panes, and then you can go do like the 30-minute, the 4 or 3 hour, we'll say, and the daily. Then what you could do is you split it out, and like say right now, it's a little more volatile than it was, a few days ago, right? And then you can see that volatility is on an uptrend. You go down to the 3 hour, you can see volatility is pretty pitiful compared to March 5th. So it's all, the thing about it is that I prefer oscillators because then it's a range 1 to 100. It holds more perspective. So is there an oscillator version of the historical volatility index? Or volatility indicator. Okay, so there's the relative volatility. See, I like this. Scale 1 to 100, right? Relative volatility index. So let's give that a shot. So let's get rid of the historical volatility, and we'll add the relative volatility index. Okay, so now you have from 1 to 100. I like that a lot better. And then you have an average, an EMA of that oscillator, right? So you can tell if like volatility is rising or falling. This is what I would use. Okay. And what you can also do with this, and I'm going to get deep on this one for you, Larry. This is going to be special just for you. All right. So, and Reagan, I know you're new, so I don't know how many questions you really have, but this is some stuff that, like, if it allows me to do what I want to do, it's going to be kind of cool. So I'm going to add another RVI on, and I'm going to change the length, and we'll make it like, we'll make it 15. So let's add another art. First of all, let's make this a little more visible so you all can see it. Style thicker. Now, what's cool about this oscillator is that there seems to be a bit of overbought, oversoldness to it. It's 20 to 80. So it seems like it never wants to go to like below, like above, or not never, but once it gets to like 20, it wants to pop up, right? So interesting. And I think this is upside downside too. Let's see here, up, down. So volatility. Let's look at this script. Calculations, takeaways. What to look for? Similar to RSI. Should be well versed in differences between the two RVIs, particular advantage. RVI confirming indicator measures the standard deviation of prices, change over time, 0 to 100. RVI is above 50. Volatility is upside. Okay, so it's easy. I would put a line at 50 for these. And there is one. There's a dotted line, but I'll just make it more like easy to see. Okay, all right, and we'll make these the same. So yeah, this is kind of cool. And then what I'm going to do is I'm going to add another one of these on there, and I'm going to change the length, and we're going to have like an EMA cross for this thing, and it'll be predictive. So if I go to RVI, right? So if I go to relative volatility, I add another one. Okay, and then I will make this. I will disappear the purple. I will make the MA blue, and then no, let's not do that. It's the wrong one. Sorry. I'm going to disappear this purple, make this one blue, and make it more visible as well. And then I'm going to change the length. Whoops, forgot to change the length.
You're getting rid of the RVI? Is that what you're getting rid of?
Yeah, I got rid of the RVI. On the second one, the first one stays. I'm going to just change this to 15 just to see what happens. I'm going to change the length to the 15. Okay.
Are you keeping it 10 on the first one?
Keep it at 10 on the first one. No, that wasn't enough. Let's change the length to 25. Okay. It's not a big difference. That may not be useful. But you'll see here that there's kind of a MACD type effect. There's a signal line, you know what I'm saying? Like there's a signal versus a baseline.
Yeah.
So I might even change this second one to like 28 or 30, say 32. Why not? Throw a number out there. So the EMA itself, like it's kind of good to see the purple, the actual RVI, because that's when it gets to overbought. That's when the volatility is going to be like wanting to change directions, right? I might even have to start playing with this myself. But then that doesn't always happen. You can get where you get this volatility and then it kind of slows down and then it keeps going. Like you think it's going to, burn out, but it doesn't. And that's where having high time frame is going to help you. So not a lot of difference between these, the smoothing here. It's the smoothing length. I wonder if I change that to like 32 down to 8.
I ran it back to 50 for smoothing. It didn't really help out.
No, you want to go down, not up. Well, actually that did not help. That did not do what I thought it would do. I'm going to run the smoothing on one of these higher. We'll do 50 like you did. Just see what happens. Ooh, nasty. Let's go back to where was it originally? So let's go to defaults and I'll put the top to 32. Shit. Reset settings. There we go. 10. And we'll take this to 32. And we'll move this to blue. You got to monkey with it to get desired results, right? Okay. I'm going to have to go here pretty quick, guys. But you see, this is pretty effective. So let me go ahead and apply it to entire layout. And you'll get, when you get that convergence divergence, that actually is going to give you some clues. Like you might get a top out here, but you see how a price, like in particular on this one right here, you get a top out where the purple like literally hits 80, which is where it's going to want to reverse down. But you see it continues up. So the actual divergence here where the two RVIs cross each other is where you see the big move. It starts to diverge right here, but it never does. It comes back up above itself. And here where you get a convergence and then a divergence up, you get bullishness right away, but it doesn't continue. So maybe the high time frame is going to help you with that. So I don't know. It's something I got to monkey with, like to get the numbers right. I'm literally like making this up as I go. But if you just stuck with the original indicator itself, that might actually be helpful. So gents, I got to run. So if you have any other questions, I know Reagan, you're kind of new into the game. So obviously you're just soaking things up, but hit me up on Telegram, guys of Algo Factory, and can answer more questions for you. Sound good?
Sounds like a plan. Thank you.
All right, gents. Thanks for coming.
Thanks, Nick.
See you.